All right, today was an interesting day. The markets were a little bearish going into the FOMC minutes that were released right about noon my time, 2 o'clock Eastern. Got to look at the Fed, what they were thinking about in terms of raising interest rates. They're apparently aware of the potential for over-tightening. Of course, that's not really necessarily an issue when you have under-tightened for so long, but that the market responded pretty positively initially on that, and then again, kind of reading between the lines, it appears like more of a knee-jerk reaction, and we ended up down. But again, just a little bit of an exhale, nothing trend changing, and that's the key, right? I'm breaking down today, what we need to see from any kind of pullback or exhale we get. That may take a week or two, just simply because of the time of year, a really, really quiet time of year. But we had a great breakout last week. It produced a lot of bullish signals. I'll show you some more today. Good potential for a bullish move to the upside by the end of the year, up to new highs and beyond going into next year. But the key is that we hold that breakout. So I'm going to show you, some of the signs that we may not be as bullish as we think we have been over the last little bit, and why that may be the case, and why we still need to be very, very aware of the possibility of a fake out occurring. So I'll show you that, and our trade idea will help us in case that happens, especially help us offset one of the current trades that we have going on right now, and how I'll show how they can work together. So let's go ahead and get started. Today is Wednesday, August 17th, 2022. This is the market outlook from MarketScholars.com. My name is David Settle. All right, before we get going, I invite you to subscribe to our YouTube channel, click that thumbs up icon down below the video and like our video, comment on anything that stands out to you. Join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right, and then come down here, click on this heart icon. That opens up this tab, hit that like button. Same thing here, click the thumbs up icon, it opens up this tab, hit that like button too. Again, the more you do that, it helps get our content out to all of our followers on those social media platforms. All right, well, let's start taking a look at the S&P 500 with the market forecast indicator. And it's like, ooh, we had a down day today. It seemed to be so rare, right? But obviously they're not. We've had plenty of down days. In fact, we've had more down days and up days in the last, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days. We've had 1, 2, 3, 4, 5, 6, 7, 8. 8 down days and 5 up days. Now, granted, we are, from 4130 to 4270. We're up 140 points in those 13 days. But down days are not unique. So that doesn't mean the world's going to end. As much as you hear on TV, is this the pause that we need? Did you just have that same question 3 days ago when we were down about this? I mean, this is not very much of a big deal. It is a close below the low of the high day, but we had that over here, right? We closed below the low of the high day. So that's not even a major thing. We had that over here as well. Close below the low of the high days. So even that's not a big deal to get that. So, it brought the near-term line. The near-term line's out of bullish territory. It's not in bearish territory, so we don't have the end. We don't have the end of the near-term rally yet. We can come right off of this. So remember, we just broke through the 62% retracement. We're pulling back to it, but we can bounce right off of it and keep going. The momentum line dip has been dipping its toe. It finishes a smidgen below the 20th percentile. So by definition, that is a bullish intermediate confirmation signal. When you have the intermediate line above 80 and the momentum line in red below 20, it's at 19.87. So again, by definition, that's a bullish short-term signal. So there's a decent chance we can just come right off of this 62% retracement and keep going up towards resistance here. Which, of course, as we all know, would be above the 200-day moving average, because that was famously hit, as a lot of people know, with yesterday's intraday high point. But your intermediate posture is still strongly bullish. Your market sentiment's rising. It's out of the bearish territory now, just barely, but it's out of bearish territory. So it's moving its way up towards bullish territory. So again, very good signals that we didn't. I guess we did get that over here in March. We did get the market sentiment to, on a lagging basis, come out of bearish territory. There wasn't in bearish territory for very long. We had just barely started the correction. We are obviously much deeper in the correction here. The market sentiment dropped below 20, which is very rare for it to drop below 20. So this time getting out of 40 is actually a lot more significant than the last time than it did. So a good move, lots of good bullish signals coming again. Just and today's move definitely does not change that. Here's the weekly chart again. Good strong bullish close up above the Hakinyashi close up above the 200 week. Again, you can see when you get that good close on the Hakinyashi level above, you can that does a pretty good job of holding. You can see it over here as well. Over here, it did break through, and we didn't push, and we had a second leg lower in 2016. Obviously, a little different correction. We were much deeper correct. The wipeout phase of that correction occurred in 2016. We hadn't really wiped out there. That was more of a failed pullback bounce more than anything. And then again over here, we kind of failed temporarily before getting back above a few other times and taking off. So for the most part, you get that Hakinyashi close above the 40-week exponential after, while in pink shading when you're in death cross environment. And that's a pretty good sign that we have a good chance at holding it. And of course, we can always get fake outs. So there's only one period, so fake outs can happen. And again, if this ends up being a fake out, this would be one of the all-time fake outs because there's so many bullish patterns that we're seeing. So if it is a fake out, this very well could be the beginning of a bear market, right? That could lead, because ultimately you get the all-time fake outs that start bear markets. So we'll see if that ends up being the case here. But as of right now, you would expect that it won't be, because there's a lot more corrections in the markets than there are bear markets. So we'd expect that we'd continue to push up to new highs here. We are still in green shading across the board on the 3 green arrows. We don't have a red arrow yet on the MACD. We do on the Q. So the Qs actually is now out of green shading. You can see how the shading extends beyond the candle and all these others, but not on this one. So the Qs now has, just like this one, has started not having pink green shading. That doesn't mean we're bearish, right? You have to get pink shading and then hold that pink shading for more than a day or two. And so that's the very, very beginning of any kind of weakness, but it doesn't necessarily mean that we're bearish. If you look at the 3 green arrow charts here, you can see the failure at the 200 days so far. There's also a lot of volume up here, so it's not just the 200-day moving average. There's a tremendous amount of volume in the past year at these levels. Obviously, the MACD hasn't gotten the red arrow yet, so we're not in convergence mode. Stochastic's also above its moving average. So you can see it's still kind of holding there and still above the 8-day moving average. Remember, it doesn't really turn negative until you get below the 17-day moving average. That's when things really kind of hit the fan there. So we're okay there. The IWM is the one that's a little bit closer. Again, failed at the 200-day moving average. And now we'll see if this breakout above the 62% ends up failing or not. There's obviously a lot of volume here too from all this trading. So there's a lot more resistance than just the 200-day moving average. You also have that 78% retracement of this current intermediate rally. Small resistance there that, when you throw on top of these others, increases its significance. But you're still above the 8-day and still don't have the red arrows there. So not quite necessarily bearish per se. Looking at the DMI, we're so strongly bullish. And we're in, again, one day doesn't change the trend. The trend is still very strong on the bullish side, and same thing on the RSI and the CCI. Still very bullish and from that perspective as well. You have to get, again, to change the trend, you have to get below minus 100 for more than just like a little dip. You have to get below 30 to break out of this, like we did over here, to really kind of be bearish. And obviously, we're just barely below 70. So, it might mean that our divergent move to the upside, which is the trending momentum move to the upside, is done. I would venture to guess now that we will no longer have momentum to the upside. Doesn't mean we have to go down. You can see the momentum is peaking here. We're still above the Keltner channel, but it probably means that we won't go up with the same pace anymore, and we'll at least start to converge to the upside there. We're easily above the cloud. Again, getting up and staying above the cloud by the time it turns green means that this bullish crossover is held 26 days from now. That's what that means, and that's a really good bullish reversal, kind of a long-term bullish reversal sign. So we got a very strong bullish posture still going, and bullish trend, and a good opportunity that it's more than likely going to hold. Now the stochastic, which is where we're closing relative to the 4-week range, it's down. It's still above 80, but it's down below its moving average. Its moving average is above 80. And you can see when you break down below that, it can even still be convergent mode, right? So that's why I say we don't have to drop. We can still go up, but just obviously not nearly the pace as we did originally over here. But once you break below that average, it tends to be more bearish. So that's what we have right now. Your whole, the whole moving average chart that we look at, we did get a transition candle. We have not flipped the parabolic SAR. We are very close to it. The parabolic SAR is at 42.42. It's obviously going to move up again tomorrow by a good amount. So what, 2% or whatever. So we have a good chance that we can break it tomorrow and flip that. The hole's not red. There's 3 things you need to be. The hole needs to be red. You need to have a bearish candle, and even when it does flip, it's only going to flip to that high point, 43.25. So even if it does flip up, it's not going to flip up very far. So it's going to, very good chance it could be a very temporary bearish move. That would be a good sign that the resistance breakout that we had last Wednesday off that inflation number has held, and which means the narrative shift. That commodities are softening and yields aren't rising anymore, and the Fed's done raising rates, that narrative shift is held too from a market expectation standpoint. Let's take a look at the intraday moves, and you can see, oops, not this one, the intraday moves here. And you can see that we did get a lower high and a lower low, and we closed near the low. So we did actually late in the day on the Fed FOMC minutes, we got back above yesterday's low point, and then we basically got back down to it. We didn't get too, we're actually back up above it in the after hours. So it's not like, basically got down to that low point, which is last week's high point. So an important level, but again, a very small range. We didn't extend the low point from Monday very low. It's still roughly about the same level. Yesterday, I would not be surprised if we don't get anything higher than 431, and I wouldn't be surprised now if we don't get anything lower than 424 by the end of the week. Like, if that's the range established for the next 2 days going into the last summer weekend for a lot of people, that's very likely that we could have this grind into the weekend on very, very low volume now that we're through probably the what everybody was expecting and waiting for, the FOMC minutes. The Philly Fed will come out on Friday, and there's still some earnings, but there's a good chance that we don't move anymore going into the rest of this weekend. I showed you the volume and the range, very small. Volume ended up being 62 million, so just a little bit below the average. The range was also below the average. Again, I expect those numbers to be even smaller tomorrow without an FOMC release to get what we even got today, to get up to just slightly below the average. Volatility is flat. It's sitting right at 20. It's not breaking down below 20. It's not holding. And you remember I've shown you this before. The correlation chart with the VVIX is extremely low. You can see that when the VIX usually gets a big move higher when it's coming off of these low, not a big move, but it gets a move higher. If you look at SPY, you can see the VVIX is abnormally positively correlated with SPY, and that generally leads to the end of a bullish move. When you get that, you can see we had that bullish move. We had some volatility coming off of this one. You can see this one here. We got to the end of this bullish move, and we got a little bit of a vol. In fact, all 3 of these pullbacks right here came off of peaks on this positive correlation. All 3 of these pullbacks, that one, and that one. So it basically just means that we've extended the run about probably as far as we're going to get. And now you can expect that we'll pull back off of these peaks. You can even these smaller peaks. This little peak actually produced a little bit of a rally, but a lot of these smaller peaks that produced a drop. This peak produced this drop here. So you'd expect it will produce a drop. The question is how much of a drop, and what we really, really need to see is not breaking into that gap from last Wednesday. Hold that breakaway gap, hold it there, and keep going. That puts us to new highs by the end of the year. Like I said, the bullish signals I've been showing you are so strong. They're very similar. Like the McClellan oscillator here is very close to getting above 1,000. We're at 850, a very small number today, but we'll see how we get the next couple of days in terms of breadth. But we're really close to getting 1,000. So if we get 1,000, again, that usually solidifies the new trend. Among other things that I've shown you, the returns we've gotten over the last 20 days or so are typical returns of beginning of bull markets, right? And so things are looking really good. We just need to get those numbers. We had the breakout last Wednesday, and so that breakout can't turn into a fake out, and we need to hold over the next week or two. Again, in a normal week, this week would be enough, but considering it's a summer week and like I said, I expect tomorrow and Friday to be even less volatile than today, unless we get like a really abnormal Philly Fed coming off of that Empire manufacturing on Monday. If we, kind of do the same thing on Friday, then the market might get a little spooked by that. But other than that, expect a small, quiet week going into, the last week before Labor Day weekend. And that's, so there's a good chance the breakout might take a week or two to kind of solidify because of the lack of participation at the end, basically because of timing. And then you head into September and October, and either volatility rises like it does seasonally and we don't hold that breakout, or it doesn't, which would be great, which again, you'll probably be back up to new highs by November or easily by December. So what do you think? Do you agree with that? Do you disagree? Which camp are you in? Are you expecting this to hold? Are you expecting a major fake out here? Let me know in the comment section below, especially if you, especially like with what charts are you looking at that kind of drive, if I didn't share with you here, what other charts are you looking at that kind of drives that opinion, and share with us down below in the comment section. All right, now let's talk about what's driving the price action today. And you can see today's move was pretty much two things that typically don't go up together: the dollar and commodity prices. But they have been going up, and yields. And that's the inflation trade. Those are the three things that have been going up all year, right? If you go back year to date, here, let's go year to date, you can see it's commodities and the dollar, and then yields, right? Yields would be the inversion of this TLT. So if TLT is down, that means yields are up. Those are the three things that have been pushing stocks up. Gold's been up, part of it too, but it's been compressed because of, it still outpaced stocks and bonds, but gold underperformed cash and commodities, other commodities, because the strength in the dollar. But so that trade that's been out there all year long, that's been pressuring equities and risk appetite, reared its ugly head again today. With commodities up about 0.5% and the dollar up 0.25%. A little bit of a drop, the rally here post FOMC, but again, after a rally in bonds dropped back down to lows. The Qs were at their lows. IWM came down to its lows, and corporate debt came down to its lows. So that's something we've been kind of paying attention to as well here. If you come over here to how corporate debt has been performing relative to treasuries, and one of the relationships that we look at here, let's do the new highs and new lows. I should probably let's see here, let's try it one more time. New highs and new lows, there we go. Looks like it's barely positive, not below the moving average yet, so that's a good sign. Let's take a look at the IEI compared to corporate debt. And you can see a little bit of a jump back up. Like, we have been so bearish, and that's typical when your risk appetite, is prevalent, then IEI, which is Treasury, will underperform corporate. And this is, IEI is your 3 to 7 year kind of medium term treasuries compared to corporate debt, kind of trying to keep the same duration as possible. And so you've had a few days here in a row, 3 days in a row, of some pretty significant jumps off of the lows. You can see the MACD has turned up above its moving average pretty sharply here. You got the green arrow on the histogram. You can see the CCI is now turning up. It's not in the upper half of the chart or even into bullish territory. You also notice that The long-term, we had been bearish here, so but the histogram is turning up, kind of coincides with that turn up, and you can kind of see the RSI as well out of bearish territory. So, really, I mean, it's just a couple days. It's not, the trend hasn't changed, but you can see how risk appetite's not nearly as strong anymore. And if you look at the investment grade version of this, so 7 to 10 years on the treasuries, and then the investment grade corporate bonds, you can see it jumped up pretty sharply again too. And again, this rallies, and it's still above its 200-day moving average, where IEI really dropped below it. IEF has really jumped above and is back above the 17-day moving average. Again, the MACD turning up, the histogram turning up on the long term, and RSI, never did get significantly into bearish territory. And you can see the CCI moving up too. So in terms of risk appetite, it's important to kind of watch these relationships and how they develop. XLY to XLP, I mean, there's a million different relationships you can watch to kind of measure risk appetite. And you can see the strength in XLY over the last little bit, but look at the MACD already rolling over. So again, another sign that risk appetite is waning without necessarily getting strongly bullish. The question is how much it will wane for, right? Whether, again, if it wanes significantly, then we've got a fake out on our hands, and we need to be, prepare ourselves for that, for the ramifications of that. But if it only wanes briefly, then we know that that's okay. There's no big deal to that. Let's take a look at what they look like on an absolute basis. The dollar is back up above the 17-day moving average. A couple days ago, it was holding. It's actually back above the 30-day moving average today. MACD is green and rising. You're back above this 23% retracement level, this intermediate run. We held the 23% retracement from the market sentiment run. So again, strength in the dollar has not been good for what the markets have been doing here in this inflationary environment. Long-term bonds are back to going back down. Stocks and bonds go together in an inflationary environment. So you're back below the 50-day moving average. MACD is below its moving average and negative. So you're in this divergent mode, and a lot of volume here below you. If I go 2-year, you start to get a little bit more volume. Let's see if I have to go out further. I think it's 5-year. Actually, no, 5-year. I mean, you get below here. If this little flag pattern plays out, then again we're moving down to lower lows, and again that's not been bullish for risk appetite in general. And then commodities having held their 200-day moving average, bouncing back up a little bit today, but nothing significant. You're still pretty converging here. The MACD is above its moving average. It's positive. We're not back above the 17. We're not back above these moving averages yet, or Fibonacci lines yet either. So that's going to be kind of like the triumvirate, right? That's the move that will shift us back. Those. If I go back to the asset class comparison chart here and look off of that, what low point would that be? It looks like we bottomed here on June 17th is when we bottomed on the S&P. So if I were to go here from June the 18th on till now, you can see, remember, commodities and the dollar. So dollar's still up, but still lagging behind. And then bonds are up, which means yields are down. And then the gold being down too, with the little bit of strength in the dollar. But remember, it was outperforming stocks and bonds, and now it's underperforming stocks and bonds. So that trade, that kind of relaxing of the inflation trade, has really helped push equities. You can see, across the risk spectrum, Qs and IWM both hand in hand, going up to 20%, a little bit above it. Real estate also, interestingly enough, going up, considering the bearishness in that area. But whether or not this is a reprieve, again, one day doesn't change the trend. When you look at the sector moves from January let's see, not the 12 grid. When you look at the sector moves here, it would be the comparison from that same June 18th time frame. Let's go year to date first, to kind of get that picture of this inflation trade. Then you can see energy has done well, and then you have your safe havens, utility staples. Okay, so that was the trade going on here. Now from June 17th or June 18th going forward from here, that trade relaxed. Energy lagged, materials lagged. Again, the inflation trade and then XLK, XLY. But utilities, which had been bullish previously, maintained its bullishness. And then when we look at just today alone, so let's go to just today alone here, you'll see that, again, energy back up, and then utilities and staples and real estate outpacing these other more cyclical areas. So again, one day doesn't get us back on, that train, but you can see what happened today. And the question will be whether this persists and we get back to that trade, right? The bullish commodities, bullish yields, bullish dollar, and energy rising despite the bullish dollar, but then utilities and staple. And the fact that utilities really outperformed during most of that rally from June 18th to now kind of signals just how bullish that rally was, and whether or not we may have the momentum to really act on these strong bullish signals and get us going, especially considering, again, these meme stocks. When these meme stocks explode, they've exploded in the past, but they've exploded in the past at the peaks, right? At least at the intermediate peaks for these indexes, and that's what we're getting now too with Bed Bath and Beyond, and GameStop, AMC. They tend to explode at the end of these bullish intermediate runs, and so again, another sign we may lack the bullish momentum to push through this last layer of resistance. As long as we can hold, right? As long as we can hold that breakaway gap from Wednesday, don't turn it into an exhaustion gap, then we're good to go. That's the key. So, but we see the patterns, and we see what patterns we need to see or not see. Not necessarily going into the end of the week, because again, I'm going to venture to guess we're not going to get hardly any moves. Again, barring some significant headline that's abnormal. We're probably going to be very, very quiet, and pretty much a good chance we'll probably be pretty quiet next week too, going into Labor Day weekend. And then coming out of Labor Day and into volatile September and October, that volatility correlation, that abnormal correlation with the volatility of the VIX corrects itself. How does that shake out? And so that's the kind of thing we need to see. We need to see that storm pass through and see if it actually produces damage or not. And it doesn't mean it will. I mean, there's a pretty high probability it won't produce damage based on a lot of these really strong bullish signals. But we're still kind of at that tenuous mode where this can turn into a fake out. And considering all the strong bullish signals that has been sucking in a lot of people to be bullish, it would be a pretty strong fake out, which, as I mentioned before, may be the one that starts the bear market. Bear markets don't start with a bang. They start very inauspiciously. So they end with a bang. So no one will be talking about the start of a bear market. But if that fake out if this turns into a fake out, and that breakaway gap doesn't hold, then that's very well where we may be headed. So for our trade idea of the day, I want to take a look at Walmart. We already have a long call option that we've done in the prior market outlook video on Target. Target did not have the same response to its earnings that Walmart did, and it didn't really drop too hard, as you can see. And we talked about this in the market outlook live. It dropped down, but still above its 8-day moving average, and it's not surprising that we'll get some weakness considering how bullish it's been, as long as it holds support, right? And you can see our stop orders there to get out if it doesn't. But if you take a look at Walmart, if there is any kind of weakness to the downside, I wanted to look at Walmart because we had a strong rally. I mean, in fact, rallied up above the bottom of that gap, rallied above that 23% line. I mean, again, breakout pattern on earnings. Very, very good sign. But we got a pretty bearish candlestick there. And that's a shooting star. It'd be a hammer, but on the other side, very long upper shadows. Not very common to get very long upper shadows, which is what makes that, as bearish as it is. Everything else about this looks really bullish. I mean, this chart looks bullish on Walmart. You can see again above, not quite above Hakinashi close above there yet, but still, very good bullish candle closing above a lot of highs, rising PPO, 3 green arrows on the market on the MACD stochastics and moving average. We're also hitting up against the 200-day moving average, up against we hit the point of control on an intraday basis. We're at the very significant volume node there for resistance on a kind of more shorter term basis. Again, everything else strong. The MACD or the DMI. And let me split this in half so we can see kind of the short-term DMI. Very strong, right? We got up above 50, got well below 20 there. Looking at the RSI and the CCI, because of those long upper shadows, the RSI was not able to get above 70, which is kind of what you need to see to break the trend, right? When you get when you shift from bearish to bullish, you would really like to get above 70 to break that, and we didn't get above 70 there, and we had a gap down, and then here's a gap up, and you think we would get above 70 easy, but because of the long upper shadows, we weren't able to. We were above it earlier today when we were at the highs, and we didn't finish above it. So that would be really bearish if we got above 200 on the CCI but failed to get above 70 on the RSI and started to work our way back down to the downside. And you can see the Keltner channel, like we got above the Bollinger bandwidth and we got way above the Keltner channel. So I mean, look, like very, very strong breakout type move, but the long upper shadows, it makes me wonder just a little bit about the sustainability. And if it keeps going up, so what I decided to do here is to do a bearish trade, and I did a long put vertical spread. So I bought at the money put for September, so kind of a relatively short term, next 4 weeks. Sell the 135. This is what it looks like here. You can see the trade. It's relatively high probability. The max gain is easily inside of 1 standard deviation. And if it goes up, we can keep the risk really small. If it goes down, we can get pretty much double the reward for the risk. And it's depending upon where we get out, we can probably get 2 or 3 times. Remember, if we get out with a small risk, the target long call option will probably be more than offsetting that. But if the target starts to show some weakness and eventually may hit our stop order, we can offset some of that loss with what we gain here from this long put vertical. So it kind of works in conjunction with the target trade, because the targets, it has potential to be a lot longer. We can, it's a September now, but we can keep rolling it and stay in as long as it maintains its bullishness. Whereas this one's more of a shorter term trade that is just for the next couple of weeks, and again is meant to kind of help offset any weakness we may have in target. With the small risk to the upside, that would be way more than offset by the gains we'd get in that target long call. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon down below. Comment on the video. Like us on Twitter and Facebook. Join our website at marketscholars.com for free. Have a great rest of your, what is today? Wednesday night, everybody. And we'll see you all next time.